Every month last year, your income ETF sent you a check, and your wealth still shrank. That monthly check looked great, but a hidden force was quietly eating your wealth. We call that force the silent tax, and it works even when markets are rising. Stick around and you will know exactly how to measure it before your next tax bill arrives. JEPI is JP Morgan's Equity Premium Income ETF, launched in May 2020. It holds roughly 100 large-cap US stocks, similar to an S&P 500 slice. On top of those stocks, it sells covered calls through instruments called equity-linked notes. Those notes generate the extra income that funds the big monthly distributions. 3 letters, ELN, are the key to everything that follows. A covered call means you own a stock and sell someone the right to buy it at a fixed price later. The buyer pays you a premium upfront. That premium is your income. If the stock rockets past the strike price, you hand it over and miss all that upside. If the stock falls, you keep the premium but still absorb the loss. Covered calls trade potential gains for guaranteed income, a real, permanent trade-off. JEPI doesn't sell calls directly. It buys equity-linked notes from large banks. Those notes package the call, selling strategy inside a debt instrument. That legal wrapper changes everything about how your distributions are taxed. A direct stock dividend can qualify for the lower 15 or 20% long-term capital gains rate. ELN income does not qualify. The IRS taxes it as ordinary income, up to 37%. This is where the silent tax first shows up in your real tax bill. Say JEPI pays a 9% annual yield and you are in the 32% bracket. After federal tax, your net yield drops to roughly 6.1%. A plain S&P 500 fund paying around 1.4% in qualified dividends nets close to 1.2% after tax. The gap between the two narrows fast once taxes enter. That is the silent tax working. Put $10,000 into JEPI versus a total return S&P 500 fund and watch what happens. Over the 5 years ending 2024, JEPI's total return was roughly 50% cumulative. The S&P 500 total return over the same period was roughly 90% cumulative. That gap is roughly $4,000 on a $10,000 starting investment. $4,000, real money that quietly stayed on the table. Covered calls cap your upside, so you miss the market's biggest single-day gains. Research consistently shows that a large share of annual equity returns arrives in just a few days each year. Miss those days, and compounding math turns against you permanently. Premium income replaces only a fraction of the foregone capital appreciation. Compounding means your gains earn gains. It accelerates exponentially over time. At 10% annual return, $10,000 grows to roughly $67,000 in 20 years. At 6%, closer to JEPI's after-tax total return, the same money reaches only about $32,000. That $35,000 difference is the silent tax compounding quietly for 2 decades. $35,000 is a meaningful chunk of a typical household's annual income. High yield feels like profit, but a distribution is often just your own money coming back to you. When a fund pays a distribution, its net asset value drops by roughly that same amount. You are not richer after the distribution, you just hold it in a different pocket. Behavioral finance research confirms we tend to feel a cash distribution as a genuine gain. That feeling is exactly what the silent tax exploits. Emotion winning over arithmetic. The silent tax can shrink dramatically, or nearly vanish, depending on which account holds the fund. Inside a Roth IRA or a traditional IRA, distributions are sheltered from current taxation. In that shelter, JEPI's ordinary income problem is neutralized for now. In a taxable brokerage account, every monthly check creates a taxable event immediately. Matching the right investment to the right account type is called tax location strategy. Qualified dividends require the underlying stock to be held more than 60 days around the ex-dividend date. ELN payments are contractual note interest, so they never satisfy that holding requirement. The IRS treats them like bond coupon payments, ordinary income, full stop. This is not a loophole or a mistake, it is the tax code as written and consistently applied. The size of the call premium JEPI collects depends heavily on market volatility. When the VIX is elevated, premiums are fat and JEPI's yield can push well above 10%. When markets are calm, premiums shrink and the yield can drift towards 6 or 7%. The income stream you are counting on is itself volatile. It is not a fixed salary. Building a retirement budget around a variable yield is a hidden planning risk most investors overlook. JEPI's beta to the S&P 500 is roughly 0.5, meaning it has historically fallen about half as much in sharp downturns. During the 2022 bear market, JEPI declined roughly 14%, while the S&P 500 fell around 18%. That cushion is real. It is the strongest honest argument for the fund. Lower beta also means lower expected long-run return. That trade-off never disappears. Risk and return are two sides of the same coin. You cannot keep both faces up forever. One scenario exists where the silent tax is genuinely less harmful: the early years of retirement. Sequence of returns risk means a bad market in year 1 of retirement can permanently damage a portfolio. Lower volatility early in retirement preserves the principle that future compounding needs. For that narrow use case, accepting lower long-run return for lower volatility has genuine logic. The key word is narrow. It does not apply to a 30-year-old still accumulating wealth. Here is where the silent tax gets truly expensive. It compounds just like returns do. Every dollar paid in extra taxes today is a dollar that cannot compound in your portfolio tomorrow. Over 2 decades at elevated tax rates, the drag can erase a meaningful share of terminal wealth. That kind of drag can translate to several extra years of work before you can retire. Total return equals price change plus dividends. It is the only honest scorecard. Yield alone tells you nothing about whether you are getting richer or poorer. A fund yielding 10% but falling 12% in NAV has a negative total return. Divide total return by yield to see how much of the yield represents real new wealth. If that fraction is below 1, you are partially liquidating your own principal. JEPI launched in 2020, so its live track record covers only 1 full bear market and 1 bull run. 5 years of data is statistically too short to draw confident conclusions about long-run behavior. Longer simulated backtests of covered call strategies show a persistent pattern of underperformance during sustained bull markets. That historical pattern is the base rate, the prior probability you should weigh before the marketing. Through a factor investing lens, covered call funds effectively short the momentum factor. Momentum, the tendency of recent winners to keep winning, has historically been one of the most durable return factors. Selling calls caps your participation in momentum breakouts, which is precisely when missing them hurts most. Understanding factor exposure helps you see what you are truly buying beyond the yield label. One genuine diversification benefit: JEPI's returns correlate less tightly with the broad S&P 500. Lower correlation can reduce portfolio-level volatility even when individual returns are lower. Modern portfolio theory shows that blending assets with correlation below 1 can improve the efficient frontier. The benefit only materializes if you rebalance. Otherwise, correlation drift quietly erodes it. The silent tax reaches its peak cost for a high-income earner holding JEPI in a taxable account. At the 37% federal bracket combined with state tax, effective rates can exceed 45% in many states. Nearly half of every monthly distribution goes to government before you can touch it. A 9% gross yield can collapse to roughly 5% or less after that tax bite. At that point, a simple municipal bond fund may deliver a higher after-tax yield with far less complexity. JEPI charges a 0.35% expense ratio. Modest, but still a layer stacked on top of the tax drag. A plain S&P 500 index fund can charge as little as 0.03%, more than 10 times cheaper. Over 2 decades, even a small fee difference compounds into a meaningful share of terminal wealth. Stack the tax drag and the fee drag together, and the silent tax has multiple compounding layers. To be fair, some investors genuinely benefit from covered call ETFs. Context matters enormously. Retirees who need monthly cash flow and hold the fund inside a tax-sheltered account are a good fit. Investors with very low risk tolerance who would panic sell a pure equity fund in a crash may also benefit. Portfolios where behavioral discipline, simply staying invested, is worth more than theoretical return optimization. For these narrow cases, the silent tax is a known, accepted cost of a specific benefit. Young accumulators in taxable accounts are likely paying the silent tax for little measurable benefit. High earners chasing yield in taxable accounts hand the largest share of every distribution to taxes. Anyone who needs the fund to keep pace with the rising market will be consistently disappointed. Marketing spotlights the yield. The silent tax hides in the footnotes of the prospectus. Step 1. Look up the fund's total return, not just its yield, on a site like Morningstar. Step 2. Check what percentage of distributions are classified as ordinary income on the annual 1099. Step 3. Calculate your after-tax yield by multiplying gross yield by 1 minus your marginal rate. Step 4. Compare that after-tax yield to a simple benchmark like a total return index fund. Step 5. Decide which account type you would hold it in before making any move. Add fee drag, tax drag, and opportunity cost together. That is the full silent tax scorecard. In a taxable account at the 32% bracket, total drag can reach 4 to 5% annually. On a 100,000 portfolio, that is 4,000 to 5,000 per year quietly leaving your account. Over 10 years, that is 40,000 to 50,000 before compounding effects are even counted. Expected value equals probability times outcome, summed across all scenarios. For covered call funds, receiving high yield is probable, but achieving high total return is not. Expected value math consistently favors total return investing for long time horizons. Shorter time horizons or specific cash flow needs shift the expected value calculation toward income funds. Studies of covered call overlays show underperformance versus the underlying index in a majority of long rolling windows. That does not mean the fund is bad. It means the odds favor alternatives for most investors. Knowing the base rate lets you make a conscious, informed choice rather than a marketing-driven one. Blend JEPI with a total return fund, and correlation math can improve your risk-adjusted return. A modest JEPI allocation, alongside a broad index fund, can reduce portfolio volatility meaningfully. The Sharpe ratio, return per unit of risk, can improve even if total return slightly declines. This is the most intellectually honest case for including a small allocation to cover call funds. Monthly distributions also force automatic rebalancing decisions, another sneaky layer of the silent tax. Every distribution you reinvest creates a new tax lot with a new cost basis. Tracking dozens of tax lots each year adds accounting complexity and real potential for errors. A buy-and-hold total return fund generates far fewer taxable events and far less paperwork. Inflation is the original silent tax. It erodes purchasing power regardless of nominal returns. If inflation runs at 3% and your after-tax return is 5%, real return is only 2%. On $100,000, that 2% real return means your money buys 2,000 more goods per year. A total return fund with a higher real return after inflation compounds that advantage every single year. JEPI is not a scam. It does exactly what it says it does, and it does it well. The problem is not the fund. It is the mismatch between the fund and the wrong investor. The silent tax is real, measurable, and often larger than investors realize before they buy. Armed with total return data, tax analysis, and account location strategy, you can decide clearly. Pull up your income, ETF's total return chart going back at least 5 years. Find last year's 1099 DIV and locate the ordinary income versus qualified dividend breakdown. Multiply your gross distributions by your marginal tax rate to see the silent tax in actual dollars. If the fund sits in a taxable account, model what those same dollars could earn in a tax-sheltered account. Bring these numbers to a fee-only financial advisor before making any changes. The silent tax does not announce itself. That is the entire point of calling it silent. Now you know where to look, how to measure it, and how to think clearly about the trade-offs. Knowledge is the only tool that reliably turns a financial surprise into a financial decision. If this framework helped you, share it with one person who owns an income ETF. Subscribe for more quantitative finance explainers. New video every week. Drop your questions in the comments and we will tackle them in a future episode. This video is for general educational purposes only and does not constitute investment, tax, or legal advice. Past performance does not guarantee future results. Consult a qualified financial or tax professional before making any investment decisions.